Hey there, it's Walter here, and welcome aboard. We're going to talk about successful trading and setting yourself up for success. So that's what we're going to talk about today. Glad to have you here, and welcome to all of you watching the recording. So what we're going to talk about today is successful attitudes and how they affect your trading. We know, we talked about this before, we know that there are three things that are involved in profitable trading. They are your trading system. It must be set up to make money and also must fit with your beliefs about the markets. Two, it's the risk rules that you use, the risk algorithms that you use, that you deploy in the markets to make money. And the third thing is the way that you think and how well you execute your strategy, otherwise known as trading psychology. And that third thing is what we're going to talk about today. So if you have what's called a healthy psychological profile, that's the first piece, because when you are feeling good and understand that you are able to do what you want to do, in other words, you have confidence, that's half the battle. You may have, I don't know if you know the Peanuts. By the way, we're going to talk about this in the Small Accounts, Big Profits course. If you're interested in that, you can click the link below or above or whatever. I just wanted to, needed to remember that. So there is a Peanuts, Peanuts, the cartoon, Charles Schultz. I grew up with that and I loved that cartoon. And there was a character in that, I think his name was Pigpen. And everywhere Pigpen walked around, he had like a cloud above his head and he was all dirty and everything. That was his name, right? It was Pigpen, yeah. Anyway, have you ever met somebody like that where it seems like the world is always falling for them? Everything's always gone bad. And I think I mentioned the other day that my son had a really rough day. It was a couple of days ago now. And I explained to him that it's up to him to decide from now on what kind of day he's going to have, because he has choices. He can choose to wallow in his sorrows and be upset. And I know somebody, I have a friend who, or an acquaintance, I guess, who his whole life is geared upon being the victim. And you probably know people like this, where everything in his life, in fact, his whole livelihood is dependent upon being victimized. I don't know. It's a tough way to live, if you ask me. And the good news is you have a choice. As I was explaining to my son, you have a choice whether or not to wallow in these things that have occurred this day or decide to shift it to some other place. Because a lot of what we do every day, we make choices. Am I going to do this? Am I going to do that? Am I going to focus in on this? Or am I going to focus in on that? And so having a healthy psychological profile is the first step. If you do not have that, trading will become stressful. Trading becomes stressful if you do not have a strong psychological profile, a healthy one. And most people would define it as, I'm not a clinical psychologist, so I can't speak directly to all of these things. But I do know in the research, if someone is considered to be under a lot of stress, they would say that that's not a healthy psychological profile. Stress is a big deal in terms of the world of psychology. So that's number one. Number two is you have to be able to make decisions based on the data that comes in. So what I mean by that is there's a lot of information when it comes to markets. You can watch Sky News and MSNBC and Bloomberg and Wall Street TV and all these channels out there. You can read all these different newspapers, Investors Business Daily, Wall Street Journal, Financial Times, The Economist magazine, which, by the way, we'll talk about this later, but it's a great way to use that magazine to define the trend, believe it or not. We'll talk about that soon. So all of these different tools and sources of information, FX Street is a good one for currency traders. All of these places you can go to get information, but you have to filter it out. And so a lot of people, what they'll do is they'll latch onto a guru and they'll go, well, I'll let the guru do that for me. And of course, as soon as the guru runs into a losing streak, you throw that guru away and you find another one. It's like a trading system. As soon as a trading system has a losing streak, oh, it must be broken, or the markets must change now. It's because of Brexit. It's not going to work anymore. That sort of thing. So it's important to note that you have to discern what you're going to focus in on. For me, it's the chart. So I'm a technical trader. I'm as close as you're ever going to see someone to be a technical trader. I'm very, very focused on making trading decisions based on what the chart looks like. So for me, that's the way to filter out all the fundamentals, as we like to call them. I'm not a fundamental trader. I don't use that stuff. If I look at that stuff, it messes me up. And I think I mentioned this before. One of the best trades I've ever had in my life, which was months and months long, 3.5 months long, I think. It was on the USD yen. I can't remember if it was 2006, I think it was around 2006, September to December, or October or August to December, something like that. If you go back and look at the charts, you'll see USD yen kept going up and up and up, and I kept adding to it, adding to it, adding to it, adding to it. And every single thing I read on the internet from the so-called expert economists and bank trade said that that was the wrong direction for the yen. They said it should go down, that the yen would strengthen, and I kept buying it, which meant the yen was weakening as the chart went up. So I focused in on the chart, and for me that works, but you have to decide what works for you. The other part of it is the discipline and the risk algorithm. So how are you going to manage risk? If you're not disciplined, your risk rules don't matter. And if you don't have risk rules, there's really no systematic approach. So in the Small Accounts, Big Profits course, our risk rules are geared to take a $1,000 account and ramp it up as quickly as possible over 300 trades. The goal is 100,000. That's what our goal is. Now, most traders actually have a different goal, or at least a different set of rules that determine what they do. I'll give you an example. If you've ever been to a point where or been in a position where the market offers you a trade, like you take a trade and then you decide that because the market's gone against you, you're going to move your stop. See, I used to do a lot of that when I first started trading, first 4 years of it. I used to move my stop because I said, you know what, this trade is right. I just timed it a little bit wrong. Okay, so what that means is when I set the trade up and I said, I'm going to buy here, my stop loss is down here. And then later on, I said, no, my stop loss is down here. Guess what? My risk rules are out the window. I'm no longer risking 2% for that trade. Now I'm risking 4%. And if I move my stop loss again, now I'm risking 6 or 8 or 10. And where does it end? So that's not being very disciplined. If you have rules that you stick to, you're being disciplined, obviously, and you can reward yourself for that. It's a great way to improve your discipline. But the risk management rules that most traders abide by, they're not aware of, which is when I reach X amount of drawdown, I will quit trading. That's the number one risk management rule that almost all traders abide by. You may not have defined that like consciously, but subconsciously, there's somewhere in your head a level where if you hit that drawdown, you're going to quit. It could be 15% drawdown. It could be 30%. It could be 40% or 50% drawdown. I don't know what it is. For everyone, it's different. But those rules actually dictate what you do, and they'll tell you when you're going to stop trading. So if you're not aware of that going into the game, then later on when they creep up, it's going to affect you, and you're probably going to stop trading because you've hit that catastrophic drawdown level and you didn't recognize it at the beginning. And I've done that many, many times. I'm just as guilty as anyone. But nowadays, when I go into it, I set it up. I go, what are my rules here? So for Small Accounts, Big Profits course that we're doing, the rules are accelerate the account as quickly as possible. Drawdowns are secondary. We don't want to blow up the account. That's the main thing. So in most cases, traders don't have that approach. They look at, I want to keep my money growing, and I don't want to have a drawdown of 20% or 25% or whatever it is. So if you can consciously define the rules of the game, you're much better off. Okay, next thing is consistent profits. If you don't have consistent profits, again, stress comes into the equation. So here's one thing that you can redefine the way you look at it. If you have a 30% win rate strategy, then over 100 trades, only 30 of them are going to make money. 70 of them are going to lose. You're still making consistent profits if that system has a positive expectancy. So for example, if those 30% winners make 3R or 3 times your risk, then they're going to make 90R at the end of the 100 trades on average. And the 70 losers are going to lose on average 70R. So you'll be up 20R at the end of 100 trades. So that's great. And that's brilliant. And that's awesome. And we love that, right? Yeah. But here's the thing. You're still, every time you roll the dice and you take a trade, you're still likely to have a loser. In fact, most of the time when you take a trade, it is going to be a loser. So is that consistent profits? See, some people are going to confuse that and say, well, that's not being consistent. In other words, they want to have a win rate over 50%. Well, we know from the 43 million trades that were examined at FXCM, we know that most retail traders have a better than 50% win rate. And most retail currency traders also lose money. Why? Because the loser is much bigger than the winner. And that's exactly what I was doing when I was losing. I kept moving my stop loss. So I actually had these terrible losers. And the winners, as soon as I got a little bit of profit, I would just, get out of it. So I was a classic case of that. It's the number one mistake that most traders make. They let their losers run and they cut their winners short. I'll tell you a story. A friend of mine, he's an acquaintance. I don't talk to him so much anymore, but he's an interesting trader who encouraged traders to trade for his fund. He set up this software that he had programmed in China. It's a platform that you won't find anywhere else. It's custom made. And his traders would go on demo account. And if they qualify, then they would get to trade real money and they could share in the profits. Well, what he was doing, and he didn't tell them this, that's why I think it's unethical. He flipped their trades around. So everyone who was qualifying to trade for the fund, their trades were actually reversed. So what does that mean? It means that his fund was making money on the back of traders who were trying to qualify. And his biggest problem was trying to convince these traders to keep trading because they all wanted to quit. He said, no, keep going. And I said, this is crazy. How do you keep encouraging your best losing traders to try and qualify for the fund? Because those were actually his best winning traders because he was reversing their trades. And I said, aren't you worried that you're going to get a really good winner? And he did. Occasionally he'd get a winning trader and he'd move them over to the fund and he'd say, okay, now we're going to trade your money. And then he said they'd have losing streaks too, though. But his focus was on keeping the losing traders in the game and trying to qualify. And I said, surely you must be worried that someone's going to cut their losers short and let their winners run. And he said, no. He said they always let their losers run and they always cut their winners short. I said, wow, that's amazing, because very few of them would qualify. And so that kind of brings it home that that's the big mistake that we make as traders is we look at the win rate and how often we're winning instead of the amount of cashola that you make. So it really comes down to the expectancy formula and not how often you're winning. So hopefully this helps. The healthy psychological profile, and by the way, like doing things like running and riding your bike and swimming and things like that are active, even just going for a walk, that can help your psychology. It can help your blood flow to the brain. You get good ideas when you're doing things like that, out for a run or a walk or whatever. So that's it. Number one is healthy psychological profile, making accurate decisions based on the information you want to focus in on, having money management rules and discipline and knowing what those rules are in the beginning, and then obviously making sure that you have consistent profits, which is different from having a better than 50% win rate. I hope that this helps. We'll see you in the next video, and I wish you happy trading. See ya. Bye.